Hello, and welcome back. So, one of our subscribers mentioned a tattooed chef in my latest 3M video, and I thought it's interesting that the stock was down 37% today. I actually wasn't aware of it. Now, I was taking a look at our discussions that we had in our Discord channel, for which you can find a link in the description box below this video. And we were talking about tattooed chef a few months ago, and I vividly mentioned that I consider this a garbage stock pretty much. And while I may have been exaggerating a little bit, back then, especially at the price it used to be, it was even worse than it is today, and it certainly fitted this description. Now, we're going to be taking a look and see what is the appeal with this one, and what has been happening, and whether it's a potentially interesting company to add right now, as it's crashing down to the ground. And obviously, this is a Jeremy's favorite from Financial Education, one of the world's well-known YouTubers around the space. And I kind of wanted, when I made my channel, I kind of wanted to be sort of like the voice of reason, kind of help people not basically burn money in these kinds of companies just because we are at a bullish stage in the markets. Because, when we go back to normalcy, this is what happens. And you can kind of see it here, the 5-year period that the company has been operating in lately. You will see that this was a stock that had a massive influx of buyers just because it was pushed too much. It was the era where interest rates were basically free, like, it was like free money. And so after some point, when we entered the sort of like pandemic stage where interest rates went higher, these companies couldn't really finance themselves. They're not really making money, frankly, and this pretty much crashes tremendously. Now, as this crashes at a tremendous pace here, and it's like less than $1 right now, there may be an opportunity, and this is what we're going to be talking about, because while a company may be overvalued here, it may be cheap here. Now, I'm not saying that that's the case with Tattooed Chef, by the way. We will examine that. But what is Tattooed Chef? Our tool here can tell you exactly what it is. It's a plant-based food company that produces and sells a portfolio of frozen foods and plant-based products. And I recently heard that they potentially could be looking to get into meat. Now, I myself am not a huge fan of these kinds of foods, and especially processed vegetable foods. So obviously, plant-based, I should say. Obviously, vegetables are great, but these kinds of processing is probably not very healthy for people, and I'm not a huge favorite, a huge fan of it. Now, what has been going on with the company? We can use, again, our tool here, and the tool has tons of options and tons of tools, tons of modules here that we can use. And one of these is Stock News, can give us a very, very quick overview of what is going on with the company. And so, for instance, we can check why Tattooed Chef is actually down almost 40% today. So let's take a look and understand what is going on. So why the company is down 40% today? And the core reason is that the company actually announced it would miss its SEC filing deadline for its quarterly report. And that's obviously horrible here. People are scared that the company is losing more than expected, way more than expected potentially, or maybe they would be announcing some sort of default even. And so this is why the stock actually crashed to the ground. And additionally reports that a capital raise is necessary. Now, I have mentioned it so many times in my videos that it's getting tiring. When a company doesn't make money, when they are losing money, if you're at a bullish era when money is cheap, they could potentially get some loans. People are euphoric. They could actually keep buying their issued shares, and they can continue finance themselves. But as you are exiting this era, if the company is not making money, this is a huge problem, because they will eventually crash to the ground or even default because they cannot actually raise any capital, and they cannot actually fund themselves. Or if they do raise capital, it's going to be mainly from debt, and that debt is eventually going to crash the company regardless. Because as the company grows down, and it's like the stock price is like 80 cents right now, it's not so lucrative to sell stock as it was when the company was like $20, as you can understand. You're basically giving it away for free almost, and how much money are you going to be raising out of this one? And also, your investors are going to be fearful, and from all this issuance of new stock, and it's horrible. It's a horrible picture. I mean, the stock is going to keep going down and all that. And also remember, right now, the company stock price is at 80 cents. If it stays there for a while, for a few months, they will have to reverse split, which means that they will have to actually pretty much say that one stock is and actually 20 shares is actually going to be 1 share right now. So they're going to do a reverse split so that the price goes up, like it becomes $10. So they can do like a 10-to-1 reverse split pretty much. And when this happens, the stock price more than likely is going to continue keep going down. Very, very typical thing that happens a lot. And you see it with all sorts of companies. Lately happened with Wish, for example, another company for which I have been making videos pretty much warning investors that this is going to happen, and it happened. And I think, especially if this continues to stay below the dollar level, they will have to do it. And so, yeah, be careful about this one. And what we talked about here at the statement that they made over here in a March 17 statement, the company highlights the need for an additional capital raise as soon as practicable. In this kind of fundraising environment, what I told you about, I told you about earlier, where higher interest rates mean debt financing is less welcome, it's not a great thing. And yeah, they have missed the deadline. It turns out that restating past financials takes time. So yeah, it's a horrible picture here. It's not looking great. So, as an investor, as a potential investor, is this a potential entry point here? Now, the company's P ratio, as you'll see, is negative. It has been juggling with being high in the high positives or low negatives pretty much, because the company had made some money in some quarters or fiscal years, then it started losing money again. It's not a great picture, but you know, if a company can reverse the situation, maybe it can be a cheap price over here. Now, what I don't really like is the type of business of this company, because it tends to have lower margins unless they are able to sell some premium stuff. I'm not very well aware of the exact lines of products that they are selling, but it's obviously like plant-based food for the most part, and this tends to have lower margins. Now, the outstanding shares, what I told you about earlier, they keep going up, and at some point it made sense. Like back in 2020, for example. Again, if you take a look at the 5-year chart, this was much more expensive, like in the 20s, which is insane. This was over here where like people like Jeremy, I believe, were talking about the company. This was terrible. Like this was extremely overpriced. I wouldn't touch this with a 10-foot pole. So yeah, and the revenue growth of the company is the nice thing because it has been increasing, but the net income has been going up and down, and right now it's in the negatives with the same thing with the free cash flow. And the total equity is up just because of pretty much stock issuance is what is going on. It's 27%, that's a lot. The margins are down, and when when they are up, it's going to be all over the place because we don't have too many quarters of profitability to actually evaluate solid margins. And they haven't had too much debt yet, but this will probably change in the upcoming quarters, just because they cannot finance themselves, they're not making money. And so if you take a look at the financial statements, you will see here that the company has been increasing their revenue, and they did have a year of sort of like solid net income here, and then back to negative territory. It looks like it was almost like a pandemic fluke here. So who knows whether they will be able to reverse that, but it's not looking great. And when this happens, I mean, the company, as I mentioned earlier, they will either have to get extra debt or issue shares, with the share issuance not being great because the stock is down that much is the problem. And the total equity of the company right now sitting at 217 million, mainly funded from additional paid-in capital, which is a stock issuance that I mentioned earlier, because the company is not making money, is the bottom line. And the cash flow statement you can see here with negative net income pretty much adjusting to even to more negative operating cash flow and more negative free cash flow over here after the adjustments for capital expenditures. Makes sense that you would see something of that sort, the company not really making any free cash flow. Now, if we examine our stock evaluator here, a stock evaluation tool, you will see that the revenue growth of the company has been pretty solid in the past few years. So for this reason, I will use solid numbers. Let's just say 10, 15, and 20%. So let's just say that the company will keep increasing its revenue, will keep doing well in terms of sales, so they will keep selling. Now, a company selling stuff doesn't mean that it's a great company to buy, by the way. Just because you're increasing your sales doesn't mean that you're a great company to buy. There are many ways to increase sales, including discounts, and so you have to always be taking a look at the profitability that the company provides. Now, the net income margins all over the place, very tough to say, really tough to say. So I will use something that will probably be typical for a company of this sort. likely their net income margins are going to be low. So I will use something like 5, 7, and 9 here. They don't do that yet, by the way. They are not doing that. So this is sort of like what you would expect from the company in the upcoming years, potentially. And I will explain what this means for potential investors when we do our valuation here. And I will use 70, 80, and 90 for the free cash flow margins that they're going to be generating, which is basically 70% of the 5% here, 80% of the 7%, and 90% of the 9%. And annual return of 13%. And I hit calculate, and you will see that our tool here tells us that this could potentially be a buy right now with these kinds of projections. Now, remember, these projections are super aggressive and the company is not there yet, so I wouldn't use this. The reason why I use these projections here is I wanted to show you that if the company reaches sort of like the profitability that they could reach if they manage to, and it becomes solid profitability through the years, then this company could be worth $1 or $2 or $4 even dollars. What they're doing right now, they're almost losing money. You could even go like 1% here. And let's just say that they marginally become profitable. So what's the stock worth right now if they are marginally profitable? And it's even less than the current price. And they are not marginally profitable, remember. So they are at the crossroads. Like they could become marginally profitable or keep losing money. So this company is an insane bet at these levels. The only good thing about it is that it is very cheap compared to what it was, not compared to what they are generating, not compared to the sales, to the income that they are generating is the thing. Compared to what they are generating right now, they are still expensive because they are not making money. And so, the company stock price could keep dropping, and I think it will keep dropping. So I wouldn't enter this company even now as it is at 80 cents. But you could definitely see some traders flocking and potentially having a short interest, pretty much squeeze here, an interest squeeze, a short squeeze, and potentially look at the stock going higher just because of that. But in terms of a business here, buying this business is extremely risky, and you would be buying something with the hope, pretty much, of it becoming a huge thing in the upcoming years. But right now, buying it is a lottery ticket, frankly, and a company of this sort is more than likely to default, not do great in the future. Now they may, I don't know. Maybe they have great plans and they manage to do better. Potentially, yes. But buying here is a very tall proposition, frankly. And if you are willing to potentially even lose all your investment just for the potential of some insane gains, maybe. But as it is right now, yeah, myself, I probably wouldn't touch this one unless I was looking to like day trade or maybe even swing trade in some situations. This stock, I think, will more than likely keep going down. Again, you never know what happens with the stock market, but based on the financials, this is just not looking great, guys. And I wanted to talk about it because it's a company that has been bumped so much, by people online and all that. And I try to preach here a more solid model of evaluating companies, evaluating stocks based on what money that they're making, right? You have to be looking at the money, guys. This is why you're investing. You're not investing for hype. Investing for hype is a trap, and especially right now in this kind of market, it's a huge trap that you really should be avoiding. Thanks for watching, and I hope you enjoyed the video. I will see you in the next one. Bye bye.